All right, we'll go ahead and get started here. Thrilled to have everybody joining us on their morning and afternoon. A quick disclosure, this is not a research report or investment advice. All opinions expressed in this webinar are those of our presenters, and past performance is not indicative of future results. So welcome to another Arrived webinar focusing on the Centennial sale process. Our speakers for today are Cameron Wu, VP of Investments, Jeff Talbert, Director of Investment Valuation, and I am Korin Hedlund, and I lead our investor relations team here at Arrived. A quick agenda for today, so we're all aligned, especially if this is your first webinar that you've attended. Cameron will walk through intro to property sales, what the philosophy and considerations look like, and then Jeff will walk through specifically the process of selling the Centennial, and then how this is different from a tax perspective when you're receiving dividends versus capital gains. And then we will jump into live Q&A. So if this is one of your first that you're attending, we typically walk through prepared remarks, and then we will take any questions that come through the chat. We'll either answer them there or do a little bit of a combo where we answer them live after prepared remarks. So keep the questions coming as we move throughout. You'll also notice our team in chat as well. We're thrilled to have you all here today. And without further ado, I would love to welcome Cameron up to the stage.
All right, thanks, Korin, and thank you everybody for joining us today. So I'm going to quickly go through some high-level remarks about what is our philosophy on selling properties, and then what do we really consider before we go into that selling mode. And then I'll quickly go through a couple of a 15 process step of what it looks like to sell a property, and then Jeff will go through Centennial specifically. So our philosophy at a high level is this: we expect hold times to be 5 to 7 years, but it's flexible. Generally, real estate performs better when viewed as a long-term investment. You don't want to be day trading real estate in a sense, because there are transaction costs with transferring properties, and then there's a lot of administrative overhead, and it could take a little bit of time. So you generally want to hold it for a long period of time, because even if you're right about your thesis, if you sell it too quickly, then your gain is going to be eaten up by those transaction costs. So you really want to hold it for that longer period of time. And our North Star on, getting more precise on how long exactly do you hold it is this. So if you can hold it for longer and you're going to get a better overall return annualized, then we'll keep holding it. So maybe that rental operations have been going well, but the market hasn't really appreciated, and it's been 5 years. That's okay. We can keep holding it. And that's kind of the beauty of rental income producing real estate, is that you have the option to hold it for a longer period of time, because that cash flow coming from it is going to support the holding of that investment for a longer period of time. So and on the flip side, if we hold it for a shorter period of time and can sell it quickly for a nice gain, like a flipper might, then that thesis is also viable. So, we really look at just that overall return and then decide, is the right time to sell now, in the future, or, should we have already listed that property? Some of the other considerations, though, related to sell time is the idea of liquidity. So liquidity is extremely important. And at a high level, the idea is this: you have an asset, you want to turn it into cash. How easily, how quickly, how robust of a market is there for somebody to take that asset off of your hand and then get that liquidity? So with traditional real estate, there's really two ways. You can either sell the property, or you can take out some sort of debt, some sort of financing event. So you could do a refi, you could take out a HELOC, which stands for home equity line of credit. And despite the name equity in it, it's a line of credit. So it is taking out debt. And that has been the normal way that people have gotten liquidity out of their real estate, right? Turn it into cash flow. On Arrived, we're striving for something even better, because those two options are available to us. But because you have shares of a property, there are another set of options where you can transact those shares and then exit on your own time. So currently, for our fund products in the single family residential fund and the private credit fund, we have redemption programs available where Arrived acts as an intermediary to pay out the fair market value of your shares on a quarterly basis. So we reevaluate the value of that investment on that quarterly basis. And you can get liquidity on your own timeline, because you may have different goals. Life happens. You may need to exit sooner than anticipated. We're building up those liquidity programs. Probably one of the most exciting things coming for 2025 is a secondary market to get liquidity for your individual offerings. So you're probably more familiar with this type of liquidity, as it's much more common in our financial lives. So if you ever go on a brokerage account like, Robinhood, E-Trade, Fidelity, you've probably already participated in the secondary market because buyers and sellers directly exchange their shares. And that's what would be available for our individual offerings with an anticipated date of 2025 with this feature coming to arrive. So, we're always looking to improve on the real estate investing experience, and hold periods can always be a tricky thing. So, we have our own philosophy on how to maximize the returns for all investors. But again, if you need a different timeline, then Arrived is working on those products to make that available to you. Next, selling considerations. So, when do we go from rental mode to selling mode, right? That's one of the questions of what do we look at to make that transition? So here's some high level considerations that really constrain and color when do we decide to sell. So property vacancy, we have 18 to 24 month leases. So we have to make decisions with a long lead time because, let's say that uh, you think the property environment might be good to sell, but when we make a lease, by default, it's, a 2-year timeline. So that's kind of a long lead time. And we do bias towards those longer tenancies because, fundamentally, we just want somebody to stay there. Cost management can be difficult. Inflation makes trade costs and materials costs high. So, ultimately, we want somebody who's going to bias towards staying there for a long time. Um, but if a property does go vacant, during that time and there's a good sale potential, then we can test the market. And if we're not satisfied with those results, we can always release the property. And Jeff will show you an example later where Centennial and another property were kind of the original test subjects, and one went one path and the other went the other. So he'll go through that. Second consideration, pretty basic one: are there good gains to be had? So on a quarterly basis, we update our share prices for all of our investments. And part of that share price evaluation is reevaluating what is the value of that real estate. So if there is an opportunistic time to sell, like there was with the Centennial, and the gains look like they're going to be good, and we think that now's the time to strike and a tenant just vacated, then we can act on that. Another consideration is, are there going to be future expenses on it that are going to be pretty hefty? So we may have had a good run for 3 years or 4 years and we had little to no expenses, but at some point in time, something breaks, something major breaks, and we're going to have to pay for that. So if we can circumvent that and sell it before we get to that period where we have to, say, replace the roof for $20,000, that's effectively, tantamount to $20,000 of, pseudo gain that you can have by avoiding having to replace major components. And another consideration is it going to be a market that's going to be more difficult to operate in going forward? One of the big risks that we look at that can change really quickly is the price of insurance. Insurance is an annual contract, and with more seemingly catastrophic weather events happening more frequently, insurance costs can really change quickly. I think about maybe 5-6 years ago, the price of insurance in Florida was high, but it's astronomical now. It was somewhere around maybe 1% of the basis, um, you know, 5 years ago. So if you had a $300,000 house, then you might have $3,000 worth of an insurance expense. Now we're seeing insurance expenses more like 2.5%, and that's just a couple years worth of change. So on that same asset, you'd now be paying 2.5% times $300,000, which is $7,500 every year. So that type of change in a market can catalyze the decision to sell more quickly, especially if it's trending in the wrong way, where you know Florida's insurances industry is already pretty in a state of like chaos, and they're you have insurers pulling out, and that only compounds the problem. So we look at those anticipated hurdles in that market, and that colors both our acquisition strategy as well as the timeline of when would we sell that property. And then one of the last considerations is we want to be able to sell to owner occupants as well as rental operators. So that's why it's crucial to time the decision to sell when the property is vacant. In some situations, you probably get a buyer who is a rental operator that would pay more than an owner occupant. Usually it's the other way around, where an owner occupant is going to be the one who's in a position to make the highest and best offer, and because they're using it for their own consumption, that, they're not really considering the cash flow and the economics. It's more like, does the home meet their needs and does it fit within their budget? But that's not to say that a rental operator can't pay more or is willing to pay more. So we like to have the optionality of marketing to both operators and owner occupants, which is why we want to make sure that a property is vacant when we decide to sell it. So we can put it on the MLS and have those have the kind of the maximum audience available to consider purchasing the property. And then finally, I'll go through kind of this 15-step process and just have some call outs here. So what I basically just described was the market evaluation, right? So we want to understand whether that market is in a position to have good gains for the asset in there. Then we notify the property manager. We have a go-to-market strategy, basically, of how do we want to advertise this property? Is it going to be furnished, unfurnished? What kind of improvements are we going to be making on it? Are there investments we could be making on it for an owner occupant that we may not have done for a rental? So for an example, a lot of times people will make strategic kitchen upgrades when they're going to sell a property, but you may not have that same appetite to spend the money for a rental operation. So those are some of the strategic elements of like, what do you exactly rehab on a property? Then we put it live on market. That's usually a pretty fast process. We have our network of brokers that have feet on the ground, and we want to make sure that we choose a brokerage partner that does have that local presence, because we hold open houses and we have a very physical presence when we're selling the home, which is kind of the opposite when we're purchasing homes. We do have brokerage with feet on the ground and eyes on the asset, and we do get inspections, but there doesn't have to be as close of a physical connection when you're acquiring home versus selling it, because a lot of times you are selling to owner occupants where there will be some soft selling techniques and a lot more engagement with that buyer's agent. Then you can kind of see the rest of it is transactional, where we're monitoring the prices, then we're negotiating on offers. But all of this is to say that selling a property is no small task. There's a lot of steps involved, which we're kind of optimizing here at Arrive to be able to both sell and rent with maximum flexibility. But we have a pretty nice program where our brokerage network, they can help us both get properties ready for rental or to purchase, and we can oscillate between the two pretty quickly. So, I don't want to repeat myself too much on these slides because Jeff is going to go through the Centennial specifics, but I'm going to invite him on stage now to go through that.
All right. Thanks, Cam. All right. Good morning, good afternoon, or good evening, even wherever you are. Thanks for tuning in. So yeah, Cameron just went over kind of the general strategy on how we sell and what we look for. And I'm going to try to zoom in a little bit on some specific aspects of why we decided to sell the Centennial. I guess I'll focus on this one on a couple different things. So market conditions and kind of timing, and then life cycle considerations. So, this being in a suburb of Charlotte, we love this area as an investment. This specific home had appreciated nicely, and we saw it going vacant at kind of an inopportune time of year. So when a property goes vacant in September, October, that is typically a weaker time of year to sell, or a weaker time of year to rent. So we knew we could be facing kind of a challenging vacancy cycle on the rental side. And also, being a 3-bedroom house, it would be easier to sell after school started. So typically a 4-bedroom, if you put that for sale in the winter, you might have a lot of families that have already settled down in their school district for the year. But in this case, a 3-bedroom is going to have pretty ubiquitous appeal. And we actually, I think, wound up selling this to a couple who didn't have kids. So it worked out perfectly. Another thing I'll point out in terms of life cycle considerations, this home was built in 2013, and 2013 is kind of, you're getting into a little bit of a risk area in terms of improvements. So there are some major life cycle things that are starting to come up around the 10 to 15 year range, HVAC, roof, things like that. So it also kind of made sense to grab the maximum value now, if we were thinking about not holding it for another 5 to 7 years additionally, after we had to make all these major expenses and replacements before maybe during the next tenancy. So there was just a lot of things that kind of lined up for us that made this an opportune time to sell. Also impact the financing strategies. This property was leveraged as well. So that also played into it a little bit. I know Cameron already discussed that, but I'm just going to highlight that again. Preparing for sale. So coming off the summer months in September, you're usually close to the peak price for the year. So you are a little bit past the peak demand season, but prices are still pretty high. So we kind of saw an opportunity to tactically sell this one. And I just keep the tactically in mind. That's going to come up again in a few slides. It was just a good time to sell it. Cameron also said this, but we have a broker partner that has boots on the ground in Charlotte, and they were instrumental in this in terms of both giving us really good comps, really good pricing analysis, as well as just being able to host open houses, things like that. So overall, this just really worked out for us in terms of getting it ready for sale, which gave us really good results, which we'll go over in a second. In terms of selling the Centennial, again, I'll go over in a second kind of the timeline of what happened, but we really hit it with the right price, the right marketing, the right activity, and we wound up getting an offer fairly quickly, which is great. So we didn't really have to do too much, continuing reviewing of activity, continuing price adjustments or things like that. I mean, honestly, the home, we put it at a competitive price, and we got it sold really quickly. Let's see, choosing an offer. So I'll go into kind of exactly how this worked. So, again, I'll focus on the tactical sales aspect. So we really have an opportunity at Arrived to, if we think something looks attractive for sale, we have the opportunity to put it up for sale at a price that we think is great, would have a great result for our investors. And see what kind of activity we get, see if we get the right buyer through the door. And if we don't get the right buyer through the door, we also have other options as well. But yeah, we got a strong offer, probably about 7 or 8% below list, but that wasn't going to do it for us. So we wound up negotiating back and forth with this buyer for about a week, and we got them up quite a bit. So we actually managed to negotiate a much better price for Arrived investors going back and forth with this buyer. And obviously we also evaluate the buyer. We evaluate all the closing terms, the contingencies, things like that. So we basically found the right person for the house, and they originally didn't want to pay the price that we wanted them to, but we went back and forth and got, I think, a win for all parties. So very happy with how everything shook out here. Here's the timeline. So we listed it on September 9th, and we wound up accepting an offer just a little over a week later. So we didn't have to adjust the list price any. We did wind up selling it for $351. I believe the initial offer came in the 330s. So they did come in much below our list at first. And we managed to negotiate them up a good amount from that, and get it closed. So once it was closed on the 18th, 10 days later, we actually got the funds distributed out to the Arrived wallets, which that's a really quick turnaround. I can tell you that was a really, really amazing work by our internal Arrived team to get the funds out to investors that quickly. And then, so next year you will receive a dividend, 1099 div that will include the details from this property. And I'm going to go over that in a second. So hitting this slide, the former tax preparer in me must say that I am not a tax professional. This is not tax advice. You need to consult a professional when you're doing your taxes, but we wanted to give you an idea of kind of what this is going to look like for you. So as an Arrived investor, you may have a portfolio of properties. So please keep in mind that the numbers we're going to show is a sample and is hypothetical. And also this information will be like mingled with all the rest of your property dividends and things like that. So your 1099 dividend won't look exactly like this, but I'm just going to kind of go over through some of the cells just to give you an idea of what the numbers are, what they might mean, and how to read this. So your ordinary dividends in box 1, you're probably used to seeing those on an arrived 1099 div. That's going to be your dividends for tax. Quick note on that, in box 5, you'll also see $10, and that is just letting you know how much of the dividends are requalified, which has a slight different tax consequence. So just know that there is for dividends that are requalified, there's a slightly different tax rate, and that's what that box 5 is. But I just wanted to point out that the box 1 includes box 5. In other words, there's not 2 separate dividends that just kind of, they overlap and letting you know about the tax consequence. Box 2, so that is the capital gains distribution. And in this case, it's $200. So this example, as you can see here, is based on the $1,000 investment. We rounded it. Roughly the gain on the shares were 20%. So it would be about $200 on the $1,000 investment. That's representing that $200. You'll also see a box called unrecaptured section 1250 gain to the right. This gets a little bit trickier. And again, I want to tread carefully here. But so that box, when you depreciate a property, and that helps you with your taxes as you go along and as you're receiving your dividends every year. When you sell the property, there is a recapture of the depreciation that you took that was reducing your tax liability every year as you owned the property. There's a recapture of that depreciation as you sell, especially as you sell for a gain. So that $100 in box 2B, that tells you how much of the box 2A number is treated slightly differently for tax purposes. And then I'll zoom down to box 3, which is the non-dividend distribution. This is effectively the return of your investment. I mean, there's some nuance there, but when you look at that number down in box 3, this is effectively the money that you originally invested in the property being returned to you. The reason it's not the full $1,000 is because some of that, again, if you've been an arrived investor for a while, you'll know that as we pay your dividends and send you the tax forms every year, not all of it comes in the form of the taxable dividends. Some of it comes in the form of a return of capital. So this is the remainder of the return of your original investment down there in box 3. Again, hopefully this gives you kind of a reasonable, overview of what you can expect when you get your 1099 div, and it'll at least help you kind of contextualize the numbers you're seeing in January when you get this form. All right, I will go to, so this is just a little brief conclusion here before we open it up to Q&A, which always awesome to see all the questions you guys have for us in the Q&A section. So Centennial, again, was a 3-bedroom in Charlotte. It was basically occupied from when we bought it all the way to August of 24, when we decided it was a good time to sell. The gross return on the property was about 34.7%, which was comprised of about 20% of appreciation and about 14.5% dividend for an annualized return of 11.2%. So, really, really happy with those returns, really happy to be able to deliver something like that to our arrived investors. And earlier I mentioned tactical, and I wanted to mention another property. Oops, excuse me. All right. I wanted to mention another property, the Dewberry. So just kind of emphasizing how arrived may take optionality in the future. So we actually listed the Dewberry for sale as well on September 2nd for $239,900. We actually got a little unlucky. There was someone who listed a house across the street from the Dewberry at a very, very low price, like exactly the same time we listed ours. We only got one showing, and it was quickly apparent to us that we weren't going to get the price that the arrived investors needed. Some of that was just kind of unfortunate. Somebody across the street listing a home for a much lower price, like well below market. There were some other things that just kind of weren't working out on this cycle. So we delisted it, and then we immediately leased it we immediately marketed it for rent and secured a lease 5 days later. So I think this shows you the power of what Arrives can do. Now that we've had the portfolio and some of our older homes are coming up on 4 years ownership plus, we can start looking at our portfolio and looking for opportunities to tactically sell and lock in some gains for our investors. And this also shows what we could do if it doesn't work out. Sometimes you list and then 2 of your neighbors list, and you just realize that these homes could sit here for 90 days or more, and maybe it's better to just rent it again and try on the next cycle. So really cool kind of example of how what Cameron was saying and what I was saying on how we look at sales, how we can use that to look at our portfolio and to try to maximize returns for Arrived investors going forward. And with that, I believe we're going to open it up for Q&A. So I think Korin and Cam are going to come back on stage, and we'll answer all these great questions I see coming into the chat.
Absolutely phenomenal. Jeff and Cameron, thank you so much for prepared remarks and walking through it. A huge kudos, Jeff and Cameron, and to the asset management team on those incredibly tight timelines from the sale with the Centennial and then moving from a sale to an immediate rental with the Dewberry. It's absolutely exceptional. You'll also notice we have Patrick in the chat too, our head of asset management, answering a lot of those questions, which is great. So keep them coming our way. We've added them to the queue here, so we'll go ahead and get started. The first one is from Ken. Do you perceive some amount of correlation between historical dividend performance and the anticipated appreciation, or are those revenue drivers completely independent? Cameron, I will kick that one to you. Oh, Jeff, you came off mute too, so maybe a little combo.
Yeah, Jeff, go ahead.
Yeah, I was just going to say that there's kind of necessarily some amount of correlation between dividends and appreciation. Typically, markets that are faster appreciating, the price is higher, thus you're going to get lower dividends. So there's definitely some correlation there. I think we do look holistically at returns, though. So while we do acknowledge that some areas are going to have higher cash flows, and thus, at least historically, probably have had lower appreciation, we do try and I think in the long run, the appreciation numbers are going to be really important for driving returns. So we do consider those as well. And I think Cameron might have some good feedback on that.
Yeah, I think Jeff's observations about the relationship between land price, asset price in rentals does make sense. I would also say that to some extent, on a smaller sample size, you'll see a lot more variation in under like the rental yields, because part of that is based on tenant performance. So you can have a tenant that absolutely is stellar, doesn't say a word with maintenance, pays their bills every year, and it's exactly what you would expect on the underwriting. And then you have other tenants that get evicted 45 days after moving in, and it's a huge sinkhole on the cost. So the component that is not correlated, that has a heavy influence on the dividend, is that rental performance. I think on a large enough portfolio, so if you're invested in the fund, you wouldn't see nearly that amount of volatility. And similarly, if you invest in 50 IPOs and just kind of have them all evenly distributed, that net dividend return to you is going to be, I think, fairly stable. But on any one house, the relationship between the dividend on that specific house and the appreciation that you get on that house in that market, I think is fairly random, because that that rental performance is going to impact the dividend a lot.
Absolutely. Yeah, definitely a great question there, Ken. Lots of quick questions coming in the queue too. Let's see. First one's from Prima. Would the property be offered to the current leaser? Jeff, I'll kick that to you.
So this is something we actually have fielded requests from existing tenants. One of the issues is that a sale like that would be an off-market sale, so it would be really hard for us to know, that we were getting the fair market value for the home if we sold it to the existing renter. I don't think it's 100% impossible that this will ever happen, but just based on based on the mechanics of it, I think typically people who are already in the home are probably going to want a reasonable deal. And maybe there's a situation where that makes sense, but I think I would say it's reasonably unlikely that we do a lot of these deals. Certainly it's possible that we would do this depending on the circumstances.
Fantastic. Awesome. And if I am ever pronouncing anybody's names phonetically incorrect, please keep me honest in the chat. I want to make sure you all are addressed. So would love to know. A good one in here from Steven, and Patrick had answered some of this in chat, but always good to answer live. Are the majority of properties fixer-upper? Jeff, I'll kick it to you too.
Sure. So I would say our portfolio is probably very modern and very not fixer-upper compared to most landlords in the US, including the big major REIT landlords. We skew towards newer properties. We skew towards higher levels of finishes, more recent vintages. Fixer-upper properties are historically, I think, what many individual investors have gone towards. They've gone towards, getting away with doing the least kind of repairs possible and getting away with like the lowest condition possible to kind of maximize their cash flow. That's a dangerous strategy. I think you wind up with a lot of costs that are hidden that way. So I guess just in summary, our portfolio is very new, and I would not consider many of our homes fixer-upper. We have bought a few flips that are some older vintages, but even those properties are improved to a very nice and kind of modern aesthetic.
Definitely. And this one follows nicely too. Jeff and Cameron, you've seen over the last, 10 or so years that the improvements a renter can make in a property, whether they're renter friendly or not, are accessible now. Do we let leasers do approved improvements? Kick it to you, Jeff.
Sure. So we allow them to do improvements, but it's always through us. It's always through approved contractors. It's always through making, like, we can review the bids, et cetera. Typically in the past, we've done things where, if a homeowner wants to add a fence, we might split the fence with them, things like that. So we can actually build value for arrived investors at the same time that we're kind of letting people make the home theirs a little bit. So for sure, we do allow it, but again, it doesn't happen too often, but when it does, it can be a benefit for both the tenant and for arrived investors.
Absolutely. Yeah, definitely a great question. All right, moving back over to the queue here. Cameron, I saw you chatting briefly with Monique. They had asked, so it sold above list price. And then I believe you wanted to add some color to the strategy. And Jeff, I know you walked through this too, so maybe a little bit of a combo question.
Yeah, definitely. So we listed it at 359,900, I believe, or maybe it was straight 359,000, but it had that 359 handle on it. And it was slightly higher than we thought we could get. Based on our comps, we thought it probably would resolve somewhere in the 340 to 350 range based on what we were seeing. And we always start a little bit high because you try to reach the area where it doesn't change your interested list of people. So whether it's 345 or 359, we're expecting that likely, the same people who would have visited the house at 345 would also visit the house at 359, because you don't want to handicap your top of funnel of who could buy it. But we also want to leave it high enough such that there's plenty of room to negotiate up and down, right? So at 359, our first offer came in at 335 within, I think, 7 days. So the people who ultimately ended up purchasing it, they saw it with their agent, they communicated that they really liked it, that they were going to send in an offer. So all the signs were good. And we were expecting that it would probably come in low. I mean, this is not the type of market where you have to offer above list, as opposed to like 3 years ago when there was just a crazy frenzy going on for properties. So they came back at 335. And, because there was a pretty far gap, we wanted to anchor them higher, to let them know psychologically that we were in a range that was pretty far off from the 335. We told them flat out that 335 wouldn't work. we countered at, I think, at 355, and then ultimately they settled at 350. We settled at 353, and then there was a 2K concession that came in for various property improvements, and they got their inspection and wanted some amount back for fixes that they thought they would have to do. So it was 351 when you net out the $2,000 concession on the property improvements. But the overall general strategy was, be reasonable, start as high as you think you can while still being reasonable. And then, we thought, okay, if we don't take this person's offer and they're at 351, what kind of risk are we taking if we say no and then wait? We're trying to get that. Will we be really trying to get that $8,000 incremental more when we already thought that was slightly higher than we thought we could get? So it was about as good of a result as we had anticipated, because we got the price range that we wanted in a very fast period. So, under contract in, I think, 10 days once all the signatures were acquired. When the average days on market right now for a property, like the average in the US, is about 80 days. So 80 days before you sell your property. And for us, it was more like 7 plus 30, so 37 days. So it was much quicker to go under contract, get the price. So, I would say overall the pricing strategy worked, but it was intentionally a little bit high. We settled for less than list, but that was the right result in our mind.
Absolutely. And then there was a follow-up here from Peter. Was there only one buyer making an offer at this time?
So yes, because of how quick it was, but it was the ideal buyer. So there was no sort of bidding war. And, quite honestly, we haven't seen that in a long time. We buy a lot more than we sell. And on the sell side, we haven't found ourselves in bidding wars, so all of our offers on properties come in significantly lower. And then, we kind of do that dance back and forth with the seller similarly. But yeah, there was only one purchaser on this, but fortunately it was our Cinderella and the shoe fit.
Awesome. I absolutely love that reference. All right, moving back over. Stephen's got one of the $1 million questions. I know you saw this in chat. Stephen, it's always great to have you here. I know you attend a lot of our webinars over time. They asked if the property was presumably cash flowing and has benefit of leverage, not currently available. What he's meaning is that none of our properties to date currently carry a mortgage. They do carry a refinance label, which means we could refinance in the future once rates become more favorable. Just a little context there. It seems odd to sell it sooner than originally anticipated, and that investors might have been better off waiting a few years. Cameron, what do you think here?
This is a great question, and I think it's debatable, right? There's no clear correct answer. There's a spectrum of outcomes that can happen. Ultimately, we're happy with the outcome, but I think Stephen's got a very good argument that could you have held it longer for a higher return? And the answer is, of course, yeah, it's possible, right? We don't know because the future is unknown. But here's what really colored our decision. There's no particular order to this, but it is the things that we considered. First, this tenant who was vacating was the only tenant we've ever had in the property, and they stayed for a while. There were very little expenses. So we thought, okay, if we have to take more tenant risk, we've already had a good run. It was fully cash flowing for the entire time that the investors owned it. There were no turn expenses. There were very minimal maintenance expenses. So from a cash flow perspective, it was about as good as we could have hoped for. So, and the tenant left it in a pretty decent condition as well. So it's not like there was a really large turn, but it had a particularly nice run on the investor cash flow that would be, you'd be taking some chances of kind of sullying that if you got another tenant in, and another tenant can ruin the cash flowing profile of that property. So we didn't want to press our luck too much because we had a great tenant in there. That's one factor. The second factor, I think I saw another participant in the chat kind of amplify this earlier message, but and Jeff had mentioned this as well. But as a 2013 vintage, it's going on its 12th year of existing as a house. So we start getting into major mechanical system like cost risk on that. And then third, I would say that this market in particular had good appreciation, like pretty quickly from 2021. And our philosophy was, well, if we can capture a lot of the appreciation in a short period of time, that'll probably produce the highest return, even on a levered investment. One of the dynamics that, like major macro dynamics that I think happened in the real estate markets overall, is that I think a lot of appreciation that would have been spread out over years was pulled forward, like because of low interest rates, because of the pandemic, and because of lower supply. Now, when we saw interest rates go up, one of the observations was that the prices didn't really go down in the market. So when you went from a 4% mortgage to a 7.5% in the course of like 9 months, you would have expected like a really steep price decrease because the affordability of a mortgage payment it became a lot less affordable. But the prices held. And looking forward, there's similar observations that as interest rates come down, there's not the expectation that prices are going to skyrocket. As interest rates go from say 7.5% down to 7, down to 6.5, down to 6. There's probably more transactional activity, but from a price perspective, the reason why there's not the anticipation of prices going up is because there's been a lot of deferred selling in the market, meaning that people have not sold their homes or they have not moved because they're locked into a low cost interest and they're not willing to substitute out of it, right? Because then their housing cost is immediately going to go up. So if they don't have to move, they won't, which is why the supply has dried up, which is also why we saw prices stabilize even as interest rates were going up. So as interest rates are coming down, we anticipate that there's going to be more supply. So all that to say that, in 3.5 years, you saw a lot of good appreciation from the time that we bought in 2021. But then from 2024 to 2026, let's say, do we expect really high appreciation? I'm not of the opinion that it's going to be there until mortgages probably get below 5%. Then I think we'll be in for another bull run in the market where prices will, sharply increase. So with all of those factors, we thought that this was a good case to demonstrate the full cycle of returns. We got the outcome we wanted. I think we priced the market correctly, but the crux of why not wait really has to do with, we think appreciation got pulled forward and there was a good cash flow and we're trying to avoid the costs in the future.
Absolutely. Yeah. Fantastic question, Stephen. So glad you asked. I love seeing the chat pop up too with more details in there and you walking through it, Cameron. All right. A good one in here from Jacob for a little bit of logistics. I'm going to kick this over to you, Jeff. Once people that are renting go month to month, I know we have a few of these, and they are technically out of the lease, is the rent higher for them until they decide to move or sign a new lease?
Yes. So our tenants will get options for a renewal about 90 days before their lease ends, roughly. And if they do not sign one of those options, they will go month to month. And I think it varies in some markets or between property managers, but roughly a 15% increase on their rent they'll pay as a fee on top of their rent until they decide to sign a new long-term lease. One of the options we gave them. So there is an opportunity cost for the tenant to not sign a lease and just kind of wait to leave when they want to. They have to pay a 15% premium on that.
Great question. All right, moving back over here. I know we're getting some questions that are a little bit outside of Centennial sale, but likely good since we're talking about sale or acquiring new properties. A good one from Peter. I'm going to kick this over to you, Cameron, just to talk a little bit of history of Arrived and where we are today. How many properties has Arrived sold to date? Sold per year on average. So maybe we walk through when we started selling shares in properties, and then perhaps both of you have more insight on how the cadence works to review new properties for sale.
Yep. So this is the inaugural sale, Centennial. It's our first investor-facing sale. So y'all are part of the Genesis sale crew. So how, if I were to just kind of play with the question more, we've been operating 3.5 years, and we've sold one. So I would say that on average, we sell 1/3 of a property per year. It's a little joke, but going forward, we'll see that our hold periods are estimated to be 5 to 7 years, and we're starting to come up on that. So I think we anticipate incrementally selling more properties through 2026. I think that the secondary market is going to really change the game in how we conceive of selling properties, because as soon as you have the option to get liquidity on your own terms, I think that also opens up a longer window for which you could hold an asset because you effectively get that same kind of market where there's buyers and sellers within the asset itself. So if you have a property that cash flows really well and it can, really sustain itself, then I anticipate that we'd hold that property for a longer period of time. Not only because appreciation hasn't really kicked in yet, but because any investor who is either selling or coming into the property are going to have a good rental experience on the cash flow side. So I think that that's really, kind of the ultimate conviction in having income producing real estate, is that it gives you a lot of optionality. So as we have that secondary market, it's an additional layer of optionality for the investors to have a very flexible timeline to hold the property. So there's definitely going to be more properties that we're going to be selling over the next couple of years just to capitalize on that appreciation that we said we pulled forward, and other properties that need a longer period of time to have the thesis, really play out. The secondary market is going to give investors that max flexibility to trade in and out on their own terms.
Absolutely. Yeah. I know that secondary market is probably one of the most requested features or functionalities that we've had at Arrive to date. Huge kudos to the team for building that into both the single family residential fund and the private credit fund, and then all the work that's going in to have that qualified by the SEC for those individual properties. So more to come. We'll be sure to share when that takes place. A couple questions on specific markets. Are you interested in purchasing new properties in Ohio market? And then I believe Randy had mentioned a question about adding more properties in Phoenix. What are your thoughts, Jeff?
Yeah, so Ohio's an area we like. A couple different places in Ohio. We like Columbus. We like Cincinnati. In the Cincinnati market, we actually like the northern Kentucky suburbs of Cincinnati. But yes, we do like the Ohio market. It is a place where we think there's a good amount of migration to. And I think it's away from a lot of the weather concerns that people are just increasingly growing wary of potentially being too far south, like your Florida or your Texas. So yeah, I think Ohio is a very interesting market, and we have a reasonable amount of homes there, and we're always underwriting there. So interested in adding more for sure.
Absolutely.
And then Phoenix. So I'm going to answer this one two ways. So an interesting thing about the hot markets is, Phoenix, Boise, Austin, Texas, things like that. The areas that really went up a ton during the pandemic, those areas have actually seen kind of a sideways to even slightly down movement maybe over the last couple of years. But what's really interesting is kind of the micro thesis you can have within a larger market. So if you just said Phoenix as a whole, I think Phoenix as a whole is pretty pricey still. However, when you zoom in on Phoenix and say, oh, what about Buckeye, where they're developing west towards California? What about some of the areas south, like Santan Valley? So there's little micro markets within a market. And so when we're thinking about, do we want to buy Phoenix? We might be thinking more in terms of the smaller geographies within a major market like Phoenix, in terms of how attractive we think each, individual area is. And yeah, there's certainly areas that have some macro tailwinds in the Phoenix area that make it very interesting to us. And we are underwriting there consistently.
Absolutely. Yeah, you're giving me a little bit of Ohio State vibes with that Buckeye mention there, Jeff. All right. There was one, since we're talking about markets, we're right here right now. I'm going to kick this one over to you, Jeff. Is the California market out of reach? A little bit of context. We have one vacation rental to date that's in Joshua Tree, but we have not expanded to California, Oregon, Washington at this point, but I'm sure you have more thoughts on this, Jeff.
Is it out of reach? No. It is not out of reach, but it is challenging. It's challenging on several different levels. It's challenging on a entity basis. There's California taxes you have to pay every year on the entity, which creates some issues with the series. I think there's also some other series considerations that make it a little bit difficult to operate in California. And that's just at the arrived entity level. There's also property level regulations and things like that. Property is also fairly expensive relative to the cash flow in California. So all those things combined make California not, a slam dunk in terms of us, going there and underwriting consistently. However, it's not out of reach. I wouldn't say it's impossible that we buy there. just that we're going to have to be extremely careful when we do. We're going to have to buy the right type of asset. We're going to have very strong conviction in like not only the statewide regulations, but the local regulations. And we're going to have to make sure that we do it the right way entity-wise to make sure that arrived investors actually get good returns on those properties.
Yeah, and I think that Jeff's been talking about two areas of consideration. One is economics, and the other one is administration and regulatory. So there's multiple ways to play a real estate investment, though, more so than just owning the equity of a rental home. You could also fund flippers. You could buy debt secured by properties in those areas. So we've actually made quite a good number of loans, or acquired a good number of loans in the California area. So it's not that it's uninvestable for various reasons, but you just have to realize what your strengths and weaknesses are when it comes to each different investment product. So we find it much quicker and easier to pull the trigger on a debt investment and purchase a loan from a flipper who may be very local to the place and really understands the regs, and they can navigate it because they're a lifelong resident of that locality. So they have that competitive advantage, and our competitive advantage as a capital raising company, as a financier, is to be able to provide the debt and then get paid back and earn interest. So, rather than taking the 5 to 7 year view on the equity, we're taking the 6-month view on the debt and saying, okay, we're going to get good returns here. I'm sure this flipper is going to be able to sell this property for a good price, and California needs more rehabbed inventory. So it seems like a slam dunk on the debt side. So I just want to call out that there's a lot of different ways to invest. And the equity side of it, the long-term real estate, operating income and appreciation, it's a good play. It works better for some places than others, but it's also not to say that we don't sprinkle in a couple of rentals in other coastal areas where, even if the economics are seemingly expensive, there still may be very good reason to invest there. So, like, for example, I think northern Seattle, the part of the metro, is actually a really good place to invest because it kind of gets the benefits of the expansion of the light rail infrastructure there. It becomes easier and easier to live further away from the downtown Seattle center, which is more challenging. It's gotten a high income residents. So that's kind of a large tech economy. And that type of economy is conducive to moving further away and being hybrid because most of the work is done digitally. So, like, all those things together, it's like, well, yeah, northern Seattle is kind of expensive still, but it's got the right setup to be bullish for the future. So even if the yields are lower right now, the more conviction that you have on the appreciation and the future outlook of it, given the economy, the population, and the infrastructure of that metro area, it makes it easier to make that investment. But just want to call out the debt and credit side of the investment landscape to say most of the country is going to be investable. Some places work better for equity. Some places make more sense for lending.
Absolutely. Yeah, very well said. I know selfishly, I can't wait for us to expand on the Pacific Northwest corridor. All right, moving back over to the queue. I will say too, we are built on investor feedback, so keep it coming with markets that you want to see. I know we had a mention of commercial properties in 2025, so different assets. Oftentimes we'll have product feedback in here. You saw Alexa, our VP of product, is in here, so keep feedback coming our way. We want to be sure we're walking right alongside y'all and building for our investors each and every day. All right, moving back over some generic good questions, but it's a very timely one and one that could affect sale. Cameron, I'll kick this one to you. Did any of the arrived properties suffer damage, insured or uninsured, from the hurricanes this year? And does that affect sales strategy? Great questions.
Yeah, for sure. So fortunately, we had very, very minimal damage, I think. And it wasn't even in the markets that kind of received all of the headline news. So I think parts of North Carolina got beat up pretty badly. And Florida, of course, is always getting hit by some sort of weather event. We've got a couple homes in the Jacksonville area, and there were no issues there. I think during the storm that hit North Carolina, one of our Arkansas properties had a tree that fell on part of the fence, but that was about the extent of the damage. I think it was like, an $800 or $1,200 repair for that part of the fence, where we didn't have to use insurance. You wouldn't want to pay a $5,000 deductible just to do $1,200 worth of work. So, unfortunately, that one is just an operating expense that needs to be eaten. But with all things considered, I think we escaped from the damage, and it was a fairly merciful hurricane season, at least for the Arrive portfolio.
Absolutely. Yeah. Very good question, Thomas. I will say, too, we're always notifying investors. We've turned into a bit of storm watchers when those are taking place and letting investors know that we've communicated with the property managers that we have in place and ensuring the safety of our residents while maximizing returns for our investors. So if we have any exceptionally large damage, we always notify folks and then add it to the property timeline. To date, we have not had any extensive damage to communicate, a few minor things like Cameron had mentioned. All right, moving back over here. A good one from Monique. Are any of the owned properties in HOA communities? I can kick this one over to you, Jeff. And then I believe, Monique, you had a follow-up here that you would like information on how investors are represented on those boards.
Yeah. So quite a few of our properties, I don't know exactly the count, but I would certainly say more than half of our LTR of our long-term rentals are in HOAs. Typically I would say our strategy with HOAs is understand nothing and don't make too much noise. I don't think we really want to be active on the board, but we want to be ultra compliant with all the rules. We want to be, notified of every time one of our tenants is violating a rule, so we're not racking up fees and things like that for investors. So we do deal with HOAs. It is actually one of the trickier parts of building a large rental portfolio is that you have to deal with hundreds of HOAs and things like that. So I can't think of a scenario where we really, actively try and get onto the board of an HOA or really try to actively get involved with the HOA. But we certainly need to be hyper aware of the HOA, all the rules, and make sure that we're following those to keep our returns high.
Yeah, I'd say that the way that we represent investors is trying to be a good landlord. So one of the things that an HOA really likes about our the way that we construct our leases in general is that we have long-term leases. What they don't want is something like a 6-month lease and high turnover in the community, because that's just going to kind of create this sense of what's the word I'm looking for? Just like too high turnover, and then you don't feel like your neighbors, and it's not conducive to the community feel. So when we send and kind of emphasize that, hey, we're a good actor, we pay our dues, and we have 2-year leases, HOAs will generally find that favorable. So we kind of fly under the radar for the rest of the things.
Absolutely.
Transitory. That's exactly the word I was looking for. Thank you. Yes.
Thanks, Conrad. Very helpful. I would say, too, as a passive investment in real estate, I would say this is a bonus to not have to deal with an HOA. That's Cameron, Jeff, and our asset management team, Patrick, who is also in chat, who are dealing with those folks individually. So we very much appreciate that. All right, let's see here. A couple more unrelated to Centennial. Jeff and Cameron, how are you both doing on time? Cool. We'll jump right into this. Another one from Monique on property management. Who do renters think is their landlord? Is the Arrive management company or a third party? I'm going to kick this over to, sorry, Jeff.
Sorry, to me? Okay.
Yep.
So we have third party property management for our long-term rentals. So I would say that very frequently the renters do not know that Arrived is the management company, is the owner of the home. So very, very typically I've seen communications from guests say something like, oh, hey, can you ask the owner if this, can you ask the owner if that? So they probably just think it's a person. So I would say the vast majority of our residents don't necessarily know about Arrived, but I would also say some probably do their research and they look at the deed and they figure it out. So there are some people who are curious and kind of figure it out, but we do have a property management layer that is before someone would interact with Arrive the company.
Absolutely. And then I'll say for our our vacation rentals, we have a combination of Arrive property management and third party in there. And Monique, we have 2 great resources I just shared in chat with more details there if you're curious as well. All right. I think we have 2 left in here. Shifting a little bit over to vacation rentals, can you give an example of a monthly return on an investment for a vacation rental property? Cameron, I'll kick this one over to you.
Yep, sure thing. So first, I'll caveat this by saying that any one vacation rental can, perform very differently, but I'll give you a sense of what the economics look like and where the expenses are in getting to that end cash flow number. So I think first, some of the differences are that vacation rentals tend to be larger, higher end assets. So think, all in, it's somewhere around $1 million once you throw in the price of the real estate itself, plus all of the furnishings, the amenities, and the features that we put into the house that go above and beyond the typical long-term rental. Long-term rentals, you're putting in fences, maybe some appliances, window treatments, and doing any sort of restorative work. Vacation rentals, you're really trying to almost, create little mini experiences that are the reason for people to book over, say, a hotel when they're traveling places. So generally, there's higher operating expenses on a vacation rental because you do have to provide furnishings, amenities, and consumables, and then you're also paying for the utilities because, guests pay a high amount for the nightly stay, and it's kind of an all-inclusive sans the food and the drinks and things like that. So you do have those higher operating expenses. So typically, like let's take a property that is, say, $1 million, kind of all in, and let's say that vacation rental, say in the Scottsdale area, generates about $100,000 of revenue on an annual basis. The margin on that, in terms of like once you net out all the expenses, what's the end cash flow divided by how much revenue it generated, is about 50%. And that's fully burdened. That's all the consumables, that's all the expenses, that's all the management, that's all the utilities that people are using to heat the pools, watch TV. We're paying for internet bills, et cetera. So on that $100,000, you'll end up with something around $50,000 of cash flow for that stabilized unit. So you divide that by $1 million. So on an annual basis, that's about a 5% dividend. So, that's that's like a ballpark range of what we would expect on a seasoned vacation rental that has the social proof, that has good listing history, good reviews, et cetera. Because initially there's a lot of volatility in the performance of a vacation rental for a couple of reasons. One, it's discretionary spending. It's when people go on vacations. It's not a core expense like food, shelter, clothing, right? Utilities. So that can be, a function of the economy, and how well people are doing is how much demand is being generated on that. Second, you need, unlike a long-term rental where you put it up on Zillow, you have a rent, you have some pictures, and then, people look at it, that can perform a lot more like a commodity. Whereas a vacation rental requires that social proof as one of the key mechanisms to getting people to book that property. So if a property has really great pictures and a lot of features, but no reviews, it takes time to get the momentum where people will actually kind of make reservations on a property that doesn't have social proof. They're kind of the pioneers. So you usually you'll get less bookings. You have to incentivize them by, having a cheaper price. And then once it does have that history, then it can start performing. So I kind of caveat all that to say, on a more mature vacation rental with that social proof, and that's equipped to get all the kind of top of funnel listings and be searchable on Airbnb, it does take some time. But in a stabilized environment, 100K on $1 million asset, 50% margin results in 50K of cash flow, and there's your 5% dividend.
Absolutely. Yeah. Very well said, Cameron. I would say 2 on each individual offering page for single family residential properties or for the vacation rentals. If you go to the financial section, scroll down, you can actually toggle in different investment amounts to look at the hypothetical return. It's a nice interactive way to take a peek, basically recapping what Cameron walked through. The only exception would be our newest vacation rental. That's more of an experience known as the buyer's house. This is an exceptional one where we can't share hypothetical returns just because it's so separate and different than the traditional vacation rentals we have on the platform. All right, moving back over the queue. I think we only have 2 last questions before we shut our virtual webinar doors. Cameron, thinking big picture, I know you always love this intro. Which has been more successful, traditional rentals or vacation rental properties? Do you see future purchases and investments available in both types?
So yeah, definitely going forward, I think we'll continue to have vacation rentals and long-term rentals be cornerstones of equity investments into real estate. I think they're probably two of the most common uses for residential real estate on the income production side. And we've developed the groups internally to really make those long-term bets on it. As far as what has been more successful so far, I think it's hard to say because something like vacation rentals requires a longer time to get up and running. The assets are more bespoke and unique. The operating model can be a little bit different depending on the jurisdiction, and even the platform that you're using. One quick example is that if you get a reservation through Airbnb, Airbnb handles the tax reporting to the local authority that is required in most jurisdictions. It's like a remittance of the equivalent of like a hotel tax or a usage tax. And then on the long-term rental side, it has more commodity-like behavior where once it's ready to lease, then you throw it up there and you get the rental rate that the market gives you. And being a newer home and kind of one of the first leasing cycles is actually probably the nicest that it'll ever be because we just put the rehab money into it and it's kind of the first time that a tenant has lived in there. So long-term rentals, I think, are quicker to start up, and they're more predictable in terms of the revenue that you expect to get, and they behave a little bit more like a commodity than a vacation rental. I think from an income perspective, like it really depends on how you're trying to achieve your returns. With long-term rentals, I think that you will have stronger appreciation on it because the initial investment is not saddled by the furnishings, the fixtures, the equipment that you need to get an Airbnb to get a vacation rental up and running. On the flip side, vacation rentals, I've always believed this as the fundamental thesis, has a much higher monetization capability for the rental income side. So a high percentile vacation rental should be able to generate a lot more income than a long-term rental, of the equivalent amount. So if you had 3 rental properties for $333,000 each, totaling up to $1 million, the thesis is that the $1 million vacation rental home can still generate more cash flow than 3 of those long-term rentals that both cost $1 million. I don't think we've gotten to the maturity stage yet to really have that apples to apples comparison, as our vacation rental program is very young. And we started off with all third-party managers, and we felt that internalizing it in some select markets, we could deliver better performance. So we've been in that process for about a year now of getting our vacation rentals internally managed. Not all of them are, but about 15 out of the 40 that we have are internally managed, and we're starting to see some really good results from that. So I would say the jury is still out on which one is like better, but long-term rentals certainly have more appreciation potential, apples for apples, because it doesn't have the furnishing and equipment to get over the hurdle, of like recouping the cost on all of that. But a stabilized VR from an income basis should be able to outperform the cash flow than the dollar for dollar long-term rental.
Yeah, fantastic question. We'll be sure to share more data too. We just had our Q3 financial performance. We'll have Q4 coming up here in January, which we're excited to walk through, and all historical data to date. I believe there was a question in here earlier on 1031. It might have been deleted, or I can't see it on my side. But Cameron, if you could briefly walk through why we aren't doing 1031s today, and perhaps what we foresee in the future. I believe Aprenja had asked that one.
Sure. Yeah. So just to level set with everyone, a 1031 exchange is a tax advantage transaction where when you sell a property, if you buy another one for like kind purposes, then you can avoid paying the capital gains. Well, I don't want to say avoid, you can defer paying that capital gains, because basically the basis in your old asset rolls into the next asset. So that capital gain, say like on the Centennial, as an example, if you were the sole owner of that and had the 20% gain, if you bought another rental property with that same amount of money, you could avoid paying the capital gains on that sale of that property. So that requires a like kind exchange. And unfortunately, on Arrive, what you're buying is shares of a company that holds the real estate, as opposed to the actual real estate itself, where you as an individual or your LLC entity is on the deed for the that new property. That's not the case. So even though you may be selling a rental property and buying another rental property via shares of a company, that's not considered a like-kind exchange by the IRS. So you're not able to actually take advantage of that provision in the tax code. However, if you were to sell the property, we are on Arrived. We're currently kind of thinking through what are the mechanics of a 1031 whole home exchange look like, because we have all the parts necessary to do that kind of built up. We have an acquisition pipeline, we have management capabilities, we have administration and financial reporting capabilities, distributions, taxes. We have the full investment experience covered, but we've always done it in a fractional way where you're investing in the shares. It's not that far of a leap to take out the share component, offer up one of the homes as, hey, you could buy one of the homes in our pipeline. We're under contract on this one. If you find that it's actually a good investment for you to make, and let's say that you're selling a property in Washington or California and you want to buy 3 rental homes in Atlanta, Georgia, or Charlotte, North Carolina, then we would have that pipeline available for you to shop. And then it would go into the ecosystem of our usual management structure. And then, it'd be like a very similar experience to what you have right now, except you'd be the sole owner of it as opposed to a fractional owner of a different investment. So that's that's what a 1031 is and why it's not available today. But what we have looking in the future is kind of what we call a single family residential in a box. You trade out one for another, and then you can capitalize on the tax advantage.
Absolutely. Yeah. Fantastic feedback. Cameron, I so appreciate you walking through and adding color there. It's definitely an avenue that we're exploring for the future. I dropped a link in there. That's the best place to share feedback. You can always also ping support@arrive.com or use our chat function in the bottom right-hand corner there. We're always open to feedback. I would love to learn more from you. All right. I think we have one last question before we close our virtual webinar doors. It's always a good one. For young people, what would be your recommendation, properties or loans? Do you want to share a quick caveat that we're not registered advisors or heavily regulated by the SEC? So any details we're sharing here are opinions of our presenters, and we have a plethora of information too and resources. But Cameron and Jeff, I would love to hear what you all think.
Yeah. So I think investment advice is always very specific to your goals, but I'll try to talk about some generalities, because the question was specifically asked from the perspective of a young person. So, what's important about how old you are in your investment kind of journey. So, there's 2 types of capital that exist. There's financial capital, and then there's labor capital. And when you're young, you're usually short on financial capital, but you got a lot of labor capital, and you got time, and you got risk tolerance, right? So the capital that you're able to provide, namely labor capital, unlocks something special for you that somebody who's 80 years old may not have, which is risk tolerance. Because if you have a lot of labor capital and you're saying, okay, even, I'm going to make some higher risk investments because I can bear it. Because if I lose some portion of that, I'm going to be able to work my way back up because I can go work extra hard, take another job, take a different career path. I'm going to work my way out of it. So you've got time, you've got the energy to be able to take the risk, and you may have the appetite for it because your goals might be, if I really want to change my life, I need to take some bigger risks here. So I'm going to make some investments where even if I know that there's a chance that I could lose substantially all of it, there is a nice pot of gold at the end of that rainbow. And I think that was the thought, behind, say, like crypto investments. It has a nice kind of attractive proposition for a young person where it can be super high risk because that is largely an unregulated world that there's a lot of scams. There's a lot of real legitimate use cases where you could make a lot of money. There's a lot of excitement around it, but you'll see that as a lot of young people who are participating in those markets precisely for the reasons that I'm talking about, is that there's a asymmetric upside to it. And there's a risk tolerance where you got to have the risk appetite to be able to do it. You don't see Warren Buffett investing in, the newest decentralized coin. I think he's got something like $300 billion in treasury bills right now, because 4.5% on 300 billion is still an extremely large number that he's satisfied with. So, as a young person, those are the types of choices that you're able to make because you have the time and the energy to be able to recover. So we do see in the investments world that means going in on equity investments because that has the residual return where, if something goes up really high, all of that benefit accrues to you. Whereas if you're a debt holder, you might be getting higher income, but then you just get your money paid back. So it's like the best that you can do is that defined rate that the borrower owes you on interest, which can still be really good. So the second thing that I would say is that you have to look at risk adjusted returns, not just returns in a vacuum, right? So when you're looking at the risk relative to a credit investment, well, the risk profile is pretty good because as a lender, you are entitled to get paid before the equity holders. So if there's a flipper out there who is, making a bet on an investment and they could end up not making money, but then you as the lender, you get your interest and you get paid back your money. So, it really depends where you want to be on that risk return spectrum. But I, just generally say that debt investments are going to provide more deterministic returns. Your risk in debt is that you're not able to get paid back in full, right? But otherwise, you're owed your interest, and then there's mechanisms from a legal perspective to make sure that you as the debt holder get any sort of liquidated value and get paid back first before the equity holder. But on equity, you've got asymmetric upside to the upside because you can hold it for a long time. You could get 10x returns, you could get 100x returns, or you could get negative returns. So the equity is where you're taking the risk. But as a young person, I would make sure to, regardless of your, how your preferences and how you want to invest, your advantage over other investors in the market is your youth, your energy, and the time that you have available to kind of recover if something does go wrong.
Yeah, that energy piece, it's a little wild how you lose it, or I should say myself, lose it as you get older. That's not indicative for every single human, but it's very real. I appreciate you walking through it, Cameron. I know I always think about if I could go back to when I was 12 years old, I would have been buying foreclosed properties. But to Cameron's point, it's never too late to start investing and learning and growing that direction. So if there's ever any questions or more education that we can provide, let us know. We do host our Intro to Arrived webinars every Tuesday, Friday. Sometimes those are adjusted based on holidays, or if we have a special webinar like today where we're running one intro and then one webinar like today. Some really kind words in the chat. Monique said, "This was so worth my time. Thank you greatly." Gail said, "Appreciate y'all being so transparent and helpful." Lots of thank yous. So it's absolutely exceptional to have you all in the chat today. Cameron and Jeff, any closing remarks before we shut our virtual webinar doors?
Yeah, I always love doing these. I always love seeing all the amazing questions that our investors have. You guys are so inquisitive, and yeah, if you're young and you're in this webinar, you're ahead of the investing game already. You're already asking the right questions and investing in your own knowledge about investments. So you're crushing it just being here. So really love talking to you guys every time we do this.
Yep. Yeah, absolutely. I hope everybody got some usage out of the webinar today. Really excited for the first completed sale and the full loop of kind of that investment life cycle on Arrived. So we think this is kind of a watershed event. So thanks for being part of the webinar that goes through it.
Absolutely. Well, Jeff and Cameron, thank you so much for prepared remarks as always. For our team jumping in chat and answering questions today, you'll notice you had feedback or answers from folks that are on all different teams. We work very cohesively. And then thank you to everybody that stayed on for an hour 20 and the active engagement in chat. I love seeing all the thank yous and waving coming through. If you ever have any other questions, feel free to email support@arrive.com or use that chat function in the bottom right-hand corner of our platform. We'd love to chat with you. But echoing Cameron, we are so grateful to have you all be part of such a historical moment for Arrived as our first property sale in the Centennial. And we will continue to share the great news with you all as we move forward. So hope you have a great rest of your day and happy investing.
Thanks, everyone.
Thank you.
Bye, all.